One of the best parts about being a passive investor is that you don't have to have expertise in every discipline required to operate a property or any other opportunity successfully. But your general partner, they do. Once the deal closes, the real work begins behind the scenes. And the decisions that are made behind the scenes when the deal is being operated are going to materially affect the cash flow and the investor returns for the deal. So today, for this video, CEO Jered Sturm is going to sit down and unpack insurance strategy at SNS. CFO Coleman Nelson is going to talk about ongoing debt management and how that is handled here at SNS. And then finally, COO Andy Sturm is going to talk about unit turns and turn cadence here. And each conversation is going to show their expertise and judgment behind each of these different areas and the decisions that they have to make very often that are going to directly and materially impact your cash flow and your return for the investment. This is the work that SNS handles every day behind the scenes so that our investors can invest passively with confidence. Jared, thanks for taking the time here.
Yeah, looking forward to it. Thanks, Steve.
So let's jump right in with insurance. I have a couple questions written out. First one being, when a limited partner sees insurance as a line item in our budget, what are they missing about the role that it plays in protecting their investment long term?
Well, I guess to quantify that, like we're spending about $1 million a year in premium for insurance. So even if you're just looking at it as a line item, it is a large line item that we want to make sure we're maximizing. But I think the simplistic approach is to look at just the premium amount, right? Try to drive down the premium amount. But insurance is a complex thing that you're doing multiple trade-offs, right? You're exchanging risk for premium. So you want to make sure those risks that you're inheriting or exchanging are the correct ones. And so that's where the level of nuance and background comes into real value for the LPs, is knowing, okay, are we getting what we want out of this $1 million that we're spending? Are we overspending, underspending? And that's where a lot of the back end work comes in.
Mm-hmm. Can you walk me through how SNS evaluates our insurance program for a new property, and how do we understand and evaluate the risk when we're selecting certain levels of coverage?
Yeah, I mean, I'll say that we do work with a consultant. So ATW Consultants is someone who helps us understand those risks even better than the carrier and the broker. So you have your insurance carrier, your broker who connects those dots, but then we have a unbiased consultant that helps us understand those risks even more. We do have a master policy, so across our whole, all of our communities, we blanket that under one policy, which helps us with rate. But what was the question? How do we assess those risks on new acquisitions?
Yeah, and then also, like, how do you decide what different levels of coverage you actually need? Is the consultant really helping with those decisions? And like, how do you think about that?
Yeah, well, I think of risk mitigation. I think we made a separate video on this, but first and foremost, it's about like operating with integrity. So insurance is the second layer, right? Insurance is when that something goes wrong within operations that you couldn't have prevented.
Yeah.
So first and foremost, we're looking for assets that we can operate in a way that mitigates those risks. So we're looking for things that don't have lots of underlying problems, whether it be in the mechanicals or the way it was built, or let's say it was built on the side of the hill and we buy it with a retaining wall that's leaning, just asking for a landslide. Like, we'll avoid those types of assets altogether.
Yeah.
So I think that's first and foremost. But then if we do see some of those risk elements, then we're going back to the carriers and saying, can we have these endorsements on this specific asset to make sure we're covered on these? And that's a lot of back and forth that takes a very long time through the insuring process for any new acquisition.
Yeah, one example that just popped in my head is, like, if a property has a pool, for example, would that be different than a property that doesn't, I'm assuming?
For sure. And the insurance carriers, obviously this is what they do for their business, and so they're very good at getting the language either very dialed in or restrictive, however you want to look at it. But even for your pool example, the endorsements that go onto a property for a pool have all these criteria of what the insured party has to do to make sure that the coverage would apply. So specific signs that are mounted at a specific height, and is there a little life buoy and stretcher, and does the gate lock, and how often are you checking it? And we have to make sure that then our operations are able to comply with that, or else the policy would basically be void and we're paying for nothing, right? So you have to match your operations to the language of the policy. And if
Yeah.
you don't, then you potentially are paying for nothing. So it's very important that we understand that.
You talk about looking at risk up front when you're evaluating a community. Where do you think owners go wrong in that process? And then maybe specifically around insurance, how can that impact those decisions long term?
I think that insurance comes down to your insured value.
Yeah.
So like how much assets are you insuring? So I think it's TIV, or total insured value, is kind of the acronym in that niche. And then the rate. Those are kind of the two main levers that get pulled. So how much are you insuring, and then what rate do they insure you at?
Yeah.
The mistake I see, or the mistake that I think some owners can make, is they are focused too much on the rate and not on the value.
Yeah.
And they end up either over-insuring or under-insuring. And so what that means is, like, if you're insuring $1 million building, but the insurance carrier overestimates it and says, I think it's worth, $2 million, then you're going to pay $2 million times the rate. But if it actually burnt to the ground, you don't need that much money. So your premium, you're paying too much. You're over-insuring. Or the opposite, right? If you try to drive down those values too much, then you're underinsured. You're exposed. If the building burns down, you don't have enough money to rebuild it, then you're in trouble too. So the mistake is that most people focus on the rate and not on the underlying insured value.
And you mentioned earlier that as we scale, there's more opportunity to drive that rate down still. I mean, how does that scale improve our ability to negotiate pricing and coverage with time?
Yeah, I don't think it's I don't think it's necessarily just bigger equals lower rates. Bigger equals more data, and data is at times what the insurance companies will lean on for assurance.
Okay.
Really what they're looking at is, historically, how do we operate?
Yeah.
And is it proven out enough that they can be comfortable with our operations, and how it then trickles into claims, right? Because what they want is, they want to charge us $1 million a year in premium, and they want to pay out less than $1 million a year.
Yeah.
I mean, over our coming up on 20 years of operations, and several $100 million in assets under management, we've never had an insurance claim over $50,000. So if you think about that, put yourself in the shoes of the insurance carriers, and they're like, well, that is a high probability that we can continue to see that trend. Obviously, we could have a tornado come through, or something outside of our control.
Yeah.
But the things within our control, our vertical integrations, our operations, our preventative maintenance, these are all things that we're preventing risk with. So scale equals data and a track record that gives the insurance companies confidence to then drive down that rate, right? They're going to say your insured value is this, but you've proven out that you're low risk, so we're going to pull this rate down slightly. Which I may be getting ahead of your questions here, Steve, but one thing that's been interesting to me over those 20 years of learning about insurance is, I would have thought, and I still would think, that it is math, it's more science than art, but there's a considerable amount of art in insurance. And maybe that goes away with AI and over time, but there's a human behind the decision still. And so, yes, there's actuaries doing the risk calculations and trying to figure that out, but there's also a human interpreting, like, the risk profile. And if you can tell a narrative and a story to those underwriters about why we're a sure thing, or why we're taking the measures necessary, and give them confidence that we're someone who cares to avoid risk,
Yeah.
you can reduce your rate through that storytelling. And so we've gotten better and better each year of what we can do to tell that story to increase their confidence and decrease our rate. And it's pretty impactful. Now that takes a lot of time and relationship building, and crafting a story that's not too long, but will get their attention.
How do we monitor the portfolio's insurance with time? Is there some sort of system or way that it's easy to go in and make sure, hey, we're at market rate, or where we should be there with that property, or as a portfolio even?
I mean, typically we're doing renewals every single year. The renewal process takes 6 months. So it's like, once you're 6 months into the coverage, you're starting over almost, and we're going out to market typically. And this year we're taking our whole policy out to multiple brokers and restricting where they can take to only a few carriers, and making sure we're getting the best value. But every year throughout the year, we're looking at our whole portfolio, the ages of roofs, the capital improvements that we're making, and ensure we're tracking that to then convey that data to the carriers to give them confidence of where our risk profile is. In an example that might be applicable here on the nuance that goes into using that data to ensure we're paying for the correct amount of risk. This might be a little bit too into the weeds, but with insurance, you can have replacement cost or actual cash value. So replacement cost is basically like if you use a roof as an example, if the roof gets ripped off in a tornado, they will pay to replace the roof at whatever it costs to replace it. Actual cash value, they'll say, we'll pay the roof minus, we're going to depreciate it for however many years that the roof has existed. So if it's a 15-year-old roof, they might say, oh, it's already halfway through its lifespan and therefore we'll only pay for half of what it costs to replace it.
Okay.
One of the things that we did is we look at all of our data and we said, across our entire portfolio, we have no roofs that are over 10 years old because typically we're buying assets that need a lot of capital improvements. We've done those capital improvements. So our roofs are all new. So what we did to the carriers is we said, we want replacement costs on any roofs that are 10 years or newer, and we will allow actual cash value coverage on any roofs that are 10 years or older.
Okay.
Which then let them say, okay, well that takes a lot of risk off the roofs for us. We'll drive down the rate slightly. But we didn't inherit any additional risk because we don't have any roofs that are over 10 years old. But they're doing their actuary math to kind of say, well, we know most of our claims come from roofs over 10 years old, so that helps us know we're not going to have a claim. So it's knowing your portfolio well enough, tracking that data, and then being willing to, in their eyes, take some of the risk off of their plate. But really, we didn't take any risk because we don't have any roofs that old. So that level of tracking, understanding, and nuance goes into how we can add value to the LPs.
Yeah. Jered, thank you for taking the time here.
Yeah,
This was a lot of fun.
Steve. Thank you.
Coleman, thank you for joining me to talk about ongoing debt management at SNS. I'm going to jump right in with your first question here. Once a loan closes, what does ongoing debt management actually involve month to month for you?
Month to month, quarter to quarterly, it can vary. But usually at the very beginning of a loan, so say we buy a property, and those first few months, the lender is going to have a list of things. They do an inspection. They're going to say, all right, these items we want you to repair within the next either 90 days, if it's like they consider it a life safety issue, or next 365 days if it's just more of a general routine maintenance issue. And so in the loan documents, they give us those required repairs. So for that first 90 plus days, I have to work with kind of the middleman between the lender and our project manager to ensure that the project manager is completing the required repairs and then communicating that with the lender. So that's an ongoing thing with new loans.
Yeah.
On a monthly basis, we're tracking more of the metrics, like the covenants and things like that, like debt service coverage ratio, just to make sure that we're in line with what our requirements are, to make sure nothing's out of line.
Sure.
Quarterly, it depends on the lender, but specifically agency debt, so Fannie Mae, Freddie Mac, they will require quarterly updates. So they'll ask for trailing 12 income statements, rent rolls, and those sorts of things on a quarterly basis. And so just making sure we have that information ready to go and able to send that over when they require those. And then more big picture items of our debt health, just making sure on a portfolio basis and individual loan basis, what does our loan to value look like? What's our return on equity? That's the capital we have in the deal. What returns are we getting on that? Just to make sure that everything is in line with our expectations, and if something's starting to trend out of those expectations, catching it early so we can take action.
Yeah, I guess as the portfolio has grown over the years, I'm sure that's a lot to keep track of, all those different unique debt structures for each deal. How do you track everything so you don't have a small miss here and there that could lead to a big problem down the road?
Yeah, we have information in several different spaces, and so say we have our documents, our financial documents saved on our drive of important documents. So we have those, and then we have our software we use at Folio that tracks a lot of the loan information in there. And so historically, I was doing a lot of just looking in a bunch of different spots. More recently, consolidated all of that into something that's a little bit more automated. So I built a spreadsheet that pulls the data from Appfolio, and I can toggle some different factors, but it takes our trailing income statement information, it takes our current debt balances, it looks at what our mortgage payments are, and it basically produces these metrics that helps me evaluate on a monthly or quarterly basis, depending on what I'm looking at and how often I need to look at it. It helps us to keep an eye on all those things in one spot, and so that's been really helpful recently to do that. And so that way, if something is out of line, I can catch it and take action.
Yeah. What sort of early signs to you tell us that a property's debt strategy needs attention?
From, I guess, one I mentioned is debt service coverage ratio.
Yeah.
Typically lenders, it varies by lender, but what's standard is typically 1.25. So if you take your monthly or annual mortgage payment, and then what they expect is NOI minus CapEx, what cash is available for debt payments. So they look at NOI minus CapEx, that's your number that they compare to your debt. And as long as that number is more than 1.25 or X your debt, then from a lender perspective, you're good, you're safe.
Okay.
So we track that to make sure we're not getting too close to that. We also track it on the opposite end of we don't want that number getting too high. High is not a bad thing, but that means there's potential opportunity that our debt balance could potentially increase, that we could potentially pull capital out and have room for additional debt payments and take that capital and invest it in other potential deals or things like that. So that's one. Again, loan to value is another way to look at that same information as far as like, is there capital available? Return on equity is looking at what equity we have, whether that's invested, not just invested capital, but as property values increase, as we generate value through renovations and things like that, we look at what our property's valued at minus what our current debt is to see what equity we have in there and how much are we getting in return for that equity. So if that return on equity is really high, so say we're getting 12 to 15% return on equity, that means that there's either not as much equity in the deal and returns are generating pretty good, or on the other hand, if that return of equity is getting really low, that means we've got excess capital sitting in there that we're not really utilizing to its full potential. And so if return on equity is low, that means maybe this is an opportunity where we could refinance, pull money out and redeploy it, so it reduces the equity in that deal. But you can't look at any one of those alone to make a decision. You have to say, what does it look like from this angle? What does it look like from that angle? And if everything kind of aligns, then you know, okay, we can refinance, or maybe it's the time to sell, or the opposite. There's not enough room, so we just need to keep holding.
Yeah. So those are the biggest kind of factors as you compare and evaluate a refi or even like a sale or. Okay. Last question for you is there any examples that come to mind of how proactive lender communication or just early planning preserved flexibility or protected investor capital?
Yeah, a couple come to mind. One is we have a property right now that after acquisition, it got hit pretty hard with a property tax reassessment, and so taxes went up more than we had initially anticipated, and that put some strain on cash available for distributions. And so we're trying to improve operations to offset that, build up reserves and things like that. And so as we were looking at all the levers that we can pull to overcome the challenges and the headwinds that brings, one of them was we went to the lender, and we had the property for about 1.5 years at the time, and it was a 2-year interest-only period on that loan. We went to the lender and just had a discussion with them. Would they be willing to extend the interest-only for another year? And so they looked at our financials and we had a good working relationship with them so far,
Yeah.
and they were willing to do that. So without really any additional fees or anything like that, we modified the loan documents to add an additional year of interest only, and that bought us some time as we were going through finding ways to reduce expenses and increase revenue to offset those, that we were able to still provide decent returns to our investors without having to really put things on hold. And so that was one example that communication worked out really well. Another one of our smaller properties had initially, when we refinanced it, we put a 5-1 arm on it, so 5 years of fixed rate, then 1 year floating after that.
Okay.
And so the rate was really low when we started. The first year it jumped up like 2%, and then we were about to face another 2% increase, and so rates were potentially going to go up to 7.25% on that loan. But through discussions with the lender, we found out that we could extend the loan period for 3 years of fixed rate at 5.25%. So we could basically drop the rate by 2 percentage points.
Wow.
Just for extending it. We didn't extend the loan period. The loan itself doesn't change as far as the expiration, but we basically converted the 1 years of floating rate to 3 years of fixed. And so that's another example. One that we're currently working on right now is talking to a lender about the option of potentially reducing their prepayment penalty. And so we have a 3-year prepayment penalty on another property where we think that potentially we could refinance early. So we've started the discussion with the lender of, one, are they willing to do it? And so nothing has come of it yet, but the lender is open to it, but it's just, there's give and take there. And so we're working through that to see what they're willing to give, what we can give in return, and ultimately it might not work out, but just having those discussions and being transparent with the lenders, I think they appreciate that, and it helps us to be better at making decisions. And so, like, if we don't know that, if we don't ask if they're willing to waive the prepayment penalty, then we don't know. And so it never hurts to ask, and as long as we're doing it in a good faith way of maintaining that relationship.
Yeah. Coleman, this was great. Thank you for your time here today. I appreciate it.
Yeah, thanks, Steve.
Andy, thanks for taking the time to join me.
Thanks, Steve.
Yeah, we're going to dig in for you here on the operations side, specifically on unit turns and turn cadence at SNS. So I got a couple questions prepped here to give you a chance to elaborate on what we do. And the first one being, like, as an investor sitting here, they're probably wondering, like, what exactly is this term turn cadence, and why does it matter to the returns that I'm getting on my investment and in our underwriting at SNS?
Yeah, so turn cadence is kind of the pace that you do the turns, how fast you can do them, and how many turns you expect. So it's just a combination of that.
Yeah.
And so trying to anticipate that, over the next 12 months when you're budgeting and things can be a little bit complicated, but that's what we do, is we anticipate how many turns we are going to expect that year, and then how fast we're going to actually be able to turn that unit over.
Do you have a ballpark on how many of these turns you've seen throughout your career? Like, is that number even?
Yeah, I mean, I've probably directly overseen probably over 3,000 move-outs, so 3,000 turns.
Yeah.
Yeah.
So as an investor watching this, that's 3,000 reps that has gotten Andy where he's at now, and you get to benefit from that. So can you walk us through a unit turn from move out to being lease ready, including like the time frame and maybe what's changing with different renovation levels, if that even exists?
Yeah, for sure. So the move out starts before the person actually moves out. So typically in a normal move out, we're going to get some sort of notice and be able to prepare for that. But if we're taking it just from the move out, within 4 days, our project managers are going to go to that unit and do their move out inspection and a damage during residency report.
Okay.
And so that's 4 days on average, or not on average, 4 days at the max. So that includes weekends, everything. So they're usually getting there pretty fast to kind of inspect that unit. So they're going to go through, they're going to create the entire scope of work, and they're going to create simultaneously, they're going to create a material order for whatever's needed for that turnover. They're going to order any appliances and any additional things like that's needed for the turnover within that first 4 days, and schedule that delivery for whenever they anticipate the turn to be starting, which would happen. They actually schedule the turn when we receive notice. So the scheduling of the turn would already kind of be predefined most likely. So they're doing that move out inspection, creating that material order, getting all that whole turn kicked off, setting it up for the turn teams to arrive. Our guys are arriving on average 6.5 days from the time, like from when someone moves out to when they arrive is 6.5 days. So we get to that pretty quickly.
Yeah.
And that way we're able to get to it and fix it up and turn it over. That's on average, whether the unit is extensive or the unit's very easy. And one of the things that project manager does, and the way we have it allocated, is a renovated or unrenovated. So they're kind of scheduling the time or number of days that turn will take based on the allocation of if it's renovated or unrenovated, what level of work it's going to need.
Yeah.
Let's see what's next. So then the guys arrive. Typically, we're turning over a unit on average in 3.5 days or less. Obviously, if it's a very easy renovated unit, it's less. Unrenovated would be more. But we're finishing that up from move out to available in 13 days on average. And so we turn those units around pretty quick. And some of those lists are pretty heavy, where we're doing all new kitchens, all new bathrooms, flooring throughout, paint, everything. It's still 13 days or less. So.
And then you're leasing them while that's happening too.
Typically, we're leasing them. Typically, a lease would have, if that's 13 days and they gave 30-day notice, we're looking at about 43 days that leasing will have to pre-lease the unit.
I gotcha.
And so typically they're going to lease that up pretty close to that availability date, if not on that availability date.
Yeah. I mean, with those 3,000 roughly reps to you, where do those turns most often break down, and what do you do to keep the process moving efficiently?
Yeah, I think fortunately we've honed in like the actual construction aspect of it pretty well. That's not going to be where we have the problem. The problem is going to be the reliability of the residents to do what they say they're going to do or what we've asked them to do.
Yeah.
And so when someone tells us they're going to move out on August 31st and then they are unresponsive and then don't move out, that disrupts the schedule. We do add additional fees for that, for their holdover. So we hold them accountable for our costs to like readjust the schedule and things like that.
Yeah.
But I would say that's the thing that becomes most disruptive. And I mean, even a part of our process is really affirming that move out date. But, we've established that over those 3,000 move outs. It's kind of like, that hurt, a few times. And we figured out, okay, well, we really need to adjust how we make sure and solidify this move out date. So it happens less and less, but it's inevitable. People are unreliable to an extent. And that's probably the biggest hiccup.
Yeah. When you do have a turn moving more slowly than you'd like, do you track like how that would impact vacancy or NOI?
Yeah, so we track from when the person moves out to when that turn starts.
Yeah.
And so if we have some that are longer, we talk about that every single week. We look at that every single week for the future turns. And if one of them is long, we like dig into that. Why is that one long? Can we readjust the schedule? Can we move that around? Because certainly if we're averaging 6.5 days, but this one turn is taking 20 days to get to, 25 days to get to, why is that? Let's try to adjust. So we talk about that. I talk about that weekly with our project managers to make sure that schedule continues to be refined and looked at.
Yeah. When a turn goes over budget, which I'm sure happens, how does that impact the resident charges, like collections and NOI as well?
Yeah, so it does. I mean, typically, if you're going over budget on a turn, it's most likely because the resident damaged the unit, beyond reasonable wear and tear, left a ton of personal property there, something like that.
Yeah.
And so, when it comes to just like the materials that go into the turn, the labor that goes into the turn, like we're pretty spot on. We haven't missed on that frequently. But that's where you kind of get that discrepancy, and we bill back for that. Whether the person can actually pay or that charge is collectible, you don't know. It depends on that person if they'll pay it or not. But we charge for all the personal property left. We charge for the excessive unreasonable use of the apartment, bill that back to the resident, and withhold their security deposit or pursue them in collections after that. So it's detrimental to them.
Yeah, I'm sure it's kind of a headache for you to go and do that too.
Yeah. I mean, we built the whole app that does this. I built the whole app that does this. So like they create the charges, create the invoice, and when they're doing the scope of works, it's happening simultaneously. So relatively, it's not too much of an additional task on their part as this project manager to create these charges. Fortunately, it's not a super time-consuming thing. It's kind of built into the whole process.
Yeah. And last one is more high level, but across the whole portfolio, what sort of systems have you set up that help you balance that quality and speed to keep it consistent across the whole portfolio?
I think we built workflows around process, and we have that cadence where we talk about those meetings or talk about the time from move out to turn start that allows us to track that and be aware of it and move that forward.
Yeah.
I meet with Home Depot quarterly to discuss our set pricing, which is we get 125 SKUs from Home Depot that we picked out that we kind of use the same SKUs over and over again.
Yeah.
And so we negotiate and discuss those set priced items. And so it's kind of like, okay, well, how much are we paying for this countertop compared to retail? We're buying, $200,000 worth of flooring, and let's see how much we can get that price per square foot down. And so I meet with them quarterly and kind of discuss those price points, and we were able to negotiate where some really good pricing on those materials, which helps us control the costs and manage our budgets and make sure we're meeting expectations. I mean, we consistently turn under our budget. Now we might have more turns, so our total cost returns is higher, but that's just because we had maybe a move out or two more than we wanted. But the actual physical cost on a per turn basis, we're consistently under budget.
Mm-hmm. Yeah, that Home Depot Pro Extra discount, it's nice.
Yeah.
Well, Andy, thank you for taking the time today.
Yeah.
This was real helpful.
Thanks, Steve.
Appreciate it.